Crypto taxation can consume 37% of your gains if you don't plan properly. But there are completely legal strategies that can reduce your tax burden significantly, or even eliminate it entirely in some cases. The difference between paying maximum taxes and optimizing legally is often just knowledge and planning. In this comprehensive guide, I'll walk you through the legitimate tax optimization strategies that professional crypto investors use to keep more of their gains while staying completely compliant with tax law. This isn't about tax evasion, this is about tax optimization through proper planning and legal structures. Before diving into optimization strategies, you need to understand how crypto taxation actually works. Crypto as property, not currency. In most jurisdictions, cryptocurrency is treated as property for tax purposes. Every crypto to crypto trade is a taxable event. Every sale of crypto for fiat is a taxable event. Every use of crypto to purchase goods, stock, services is a taxable event. Even receiving crypto, mining, airdrops, staking can be taxable income. Two types of crypto taxation. One, capital gains. Tax, short term, holdings less than 1 year. Taxed as ordinary income, up to 37% in US. Long term, holdings more than 1 year. Preferential rates, 0%, 15%, or 20% in US. Basis calculation. Cost basis determines gain loss on each transaction. FIFO, LIFO. Accounting methods affect which assets are considered sold first. Also 2. Ordinary income tax. Mining rewards, taxed at fair market value when received. Staking rewards, generally taxed when received, not when sold. Airdrops, often taxed at fair market value when received. DeFi yields, complex treatment depending on specific activity. Common tax mistakes, not tracking cost basis properly across exchanges. Failing to report crypto to crypto transactions. Not accounting for fork distributions and airdrops. Missing staking and DeFi yield reporting requirements, inadequate record keeping for audit defense. International considerations. Tax treatment varies significantly by jurisdiction. Some countries have crypto-friendly tax policies. Others treat crypto gains as regular income, regardless of holding period tax residency. And reporting requirements can affect optimization strategies. Professional advice essential for international strategies. These are the basic strategies every crypto investor should understand and implement. Strategy 1. Long-term capital gains optimization. Hold crypto for more than 1 year to qualify for preferential tax rates. Implementation. Plan trades around 1 year holding periods. Tax savings can reduce tax rate from 37% to 0 to 20% depending on income considerations. Market risk of holding longer, opportunity cost. Advanced tip. Layer purchases to create multiple 1-year timelines. Strategy 2. Tax loss harvesting. Realize losses to offset gains for current or future tax years. Same-day trades, sell losing positions and immediately buy back. No wash sale rule for crypto in most jurisdictions. Carry forward losses. Unused losses can offset future gains. Income offset. Up to $3,000 in losses can offset ordinary income annually. Portfolio rebalancing. Use tax loss harvesting opportunities to rebalance allocations. Strategy 3. Strategic asset location. Hold different crypto assets in different types of accounts. Taxable accounts. Hold assets you plan to trade or need liquidity from retirement accounts. Hold long-term growth assets where crypto IRAs are available. Tax-advantaged accounts. Maximize growth in accounts that defer or eliminate taxes. Geographic optimization. Consider tax-advantaged jurisdictions for certain activities. Strategy 4. Income timing and recognition control when you recognize taxable income. Batch transactions, group sales in low-income years. Defer income. Delay staking, mining activities to control timing. Accelerate losses, realize losses in high-income years. Spread recognition. Use installment sales or structured transactions for large gains. Strategy 5. Charitable giving strategies. Donate appreciated crypto directly to avoid capital gains. Direct donation. Give crypto directly to qualified charities, donor-advised funds. Create flexible giving vehicles with crypto charitable remainder trusts. Generate income while avoiding immediate taxes. Tax benefits. Deduction for fair market value plus avoiding capital gains tax. Sophisticated investors use these more complex strategies for significant tax optimization. Strategy 1. Business structure optimization. Establish business entities for crypto activities, sole proprietorship parts schedule. C. Benefits. Business expense deductions, home office deductions. Drawbacks. Self-employment tax on net earnings. Best for active traders with significant expenses, LLC or corporation. Benefits. Business expense deductions, potential tax elections, S-Corp election, potential self-employment tax savings, considerations, additional compliance requirements, professional setup needed. Strategy 2. Geographic arbitrage, legal residency changes. Consider tax-friendly jurisdictions for crypto activities. No state income. Tax states: Florida, Texas, Nevada, Wyoming, etc. Requirements: establish genuine domicile and residency documentation. Driver's license, voter registration, property ownership, lease timing. Plan moves around significant gain realization. International options for eligible individuals. Puerto Rico, Act 60 tax incentives for crypto investors. Portugal, no capital gains tax on crypto, subject to change. Singapore, no capital gains tax for individual investors. Compliance must meet substantial residency requirements. Strategy: 3 retirement account strategies. Maximize crypto growth in tax advantage accounts, self directed IRAs, crypto IRAs, hold crypto directly in retirement accounts. Tax benefits: tax deferred or tax free growth limitations, contribution limits, prohibited transaction rules. Providers: specialized custodians required for crypto IRAs, solo 401k. Plans: higher contributions up to 66,000 slots annually. 2023 limits. Loan options: borrow against account value. Requirements: self-employment or business ownership. Flexibility: more investment options than traditional 401k strategy. 4. Trust and estate planning. Use trusts for multi-generational tax optimization. Grantor trusts: benefits. Growth outside of taxable estate. Income tax: grantor pays income taxes benefiting trust growth. Types: GRAT, CRUT, intentionally defective grantor trusts. Professional guidance: complex structures requiring expert setup. Charitable strategies: charitable lead trusts, transfer appreciation to heirs with minimal gift tax. Charitable remainder trusts: diversify concentrated crypto holdings. Private foundations: perpetual charitable giving with family involvement. DeFi activities create complex tax situations that require specialized strategies. Staking tax optimization, timing. Recognition: traditional view, staking rewards taxable when received. Alternative arguments: some argue taxation should occur when sold, exchanged documentation. Keep detailed records of rewards and fair market values. Professional advice: tax treatment still evolving in many jurisdictions. Pool selection strategy: tax efficient pools. Choose pools with lower reward frequencies. Compound versus claim. Auto compounding may defer some recognition, geographic considerations. Pool location may affect tax treatment, record keeping. Track basis in all staked assets and rewards. DeFi yield optimization, liquidity mining strategies, timing. Claim rewards in low-income years. Token selection: focus on tokens with favorable tax treatment. Impermanent loss may create deductible losses to offset gains. Professional tracking: use specialized software for complex DeFi taxation, yield farming tax planning. Strategy selection: choose farms with favorable risk, return, tax profiles. Harvesting timing: control when to realize gains such as losses from farming. Token swapping: plan token swaps around tax optimization needs. Protocol selection: some protocols have more tax-efficient structures. Cross-chain strategy. Chain selection: different chains may have different tax implications. Bridge transactions: understand tax treatment of cross-chain moves. Timing optimization: use cross-chain moves for tax timing strategies. Compliance: ensure proper reporting across all chains and protocols. Proper documentation is essential for both optimization strategies and audit defense. Essential record-keeping requirements: transaction records, date and time. Exact timestamps for all transactions. Transaction type: buy, sell, trade, stake, mine, airdrop, etc. Amounts: quantities of all cryptocurrencies involved. Fair market value: USD value at time of transaction, exchange charge, wallet info. Where transaction occurred, purpose: business versus investment versus personal use. Supporting documentation: exchange statements, monthly, annual statements from all platforms. Wallet addresses: documentation of all wallets and addresses used. Screenshots: backup documentation for key transactions. Professional advice: documentation of tax professional consultations. Business records: if claiming business deductions. Maintain business records. Technology solutions: crypto tax software. Popular platforms: CoinTracker, Coinly, TaxBit, CryptoTrader. Tax API integration: connect directly to exchanges for automatic import. Tax form generation: automated preparation of necessary tax forms. Audit trail: maintain detailed records for audit defense. Professional consultation: CPA specialization, work with CPAs experienced in crypto taxation. Tax attorney for complex structures or aggressive strategies. Regular reviews: annual consultation to optimize strategies. Audit defense: professional representation if selected for audit compliance. Best practices: conservative approach. When uncertain, take the more conservative tax position. Professional guidance: get written advice for aggressive strategies. Documentation: over-document rather than under-document regular updates. Stay current with evolving tax guidance. International compliance: FBR requirements: report foreign crypto accounts over $10,000. Form 8938: report foreign financial assets. Tax treaties: understand how tax treaties affect crypto taxation. Professional advice: essential for international strategies. Create a systematic approach to crypto tax optimization that works for your specific situation. Step 1: Current situation assessment. Analyze your current crypto tax position. Calculate current tax burden. Estimate taxes on current holdings if sold today. Identify optimization opportunities. Which strategies apply to your situation? Risk assessment: evaluate risk tolerance for various strategies. Professional consultation: determine if you need specialized advice. Step 2: Strategy selection and prioritization. Choose strategies based on your circumstances. Low hanging fruit: implement simple strategies first. Long term holding, tax loss harvesting. Medium complexity: consider business structures or geographic strategies. Advanced strategies: only pursue complex strategies with professional guidance. Timeline planning: implement strategies over multiple tax years if beneficial. Step 3: Implementation framework. Execute your tax optimization plan systematically. Professional team: assemble CPA, tax attorney, and financial advisor if needed. Technology setup: implement crypto tax software and tracking systems. Process documentation: create procedures for ongoing compliance. Regular review: schedule quarterly or annual strategy reviews. Step 4: Monitoring and adjustment: maintain and optimize your tax strategies over time. Performance tracking: monitor tax savings from implemented strategies. Law changes: stay updated on evolving crypto tax regulations. Strategy refinement: adjust strategies based on results and changing circumstances. Professional relationships: maintain relationships with tax professionals. Red flags to avoid: overly aggressive positions. Strategies with high audit risk: inadequate documentation. Poor record keeping that can't survive audit. Cookie cutter approaches: one size fits all strategies without customization. DIY complex strategies: attempting sophisticated strategies without professional guidance. Success metrics: effective tax rate, overall percentage of crypto gains paid in taxes. Compliance confidence: comfort level with audit defense capability. Administrative burden: time and cost of tax compliance, long-term sustainability. Strategies that work across multiple years. Stay ahead of the evolving crypto tax landscape with current developments and future preparation. 2025 tax law changes, key developments affecting crypto taxation. Infrastructure bill provisions, enhanced reporting requirements for brokers. IRS guidance updates, new guidance on DeFi, staking, and NFT state-level changes. Individual states developing crypto-specific tax rules, international coordination. OECD guidance affecting international strategies. Emerging opportunities, new strategies becoming available. Opportunity zones, using crypto gains for opportunity zone investments. Conservation easements, alternative tax advantage investment strategies. Technology advances, new tools and software improving compliance and optimization. Professional services, growing availability of crypto specialized tax professionals. Future proofing strategies, prepare for continued evolution. Flexible structures, build strategies that can adapt to changing laws. Conservative documentation, maintain records that exceed current requirements. Professional relationships, develop relationships with evolving professional expertise. Continuous education, stay informed about crypto tax developments. Long-term planning, think beyond current tax year. Multi-year strategies, plan optimization across multiple tax years. Estate planning, consider crypto in overall estate and gift tax planning. Retirement planning, integrate crypto into overall retirement tax strategy. Business succession, plan for business structure changes over time. Crypto tax optimization isn't just about saving money. It's about maximizing the wealth you can build and keep through legal compliance strategies. The key is starting early and implementing systematic approaches. Here's how to get started with crypto tax optimization. First, subscribe to this channel for ongoing updates about crypto tax law changes and optimization strategies. Second, conduct a crypto tax assessment of your current situation. Calculate what you'd owe if you sold everything today, then identify which strategies could reduce that burden. Finally, let me know in the comments what your biggest crypto tax challenge is, whether it's understanding DeFi taxation, planning for large gains, or just keeping proper records. Remember, this video is for educational purposes only and doesn't constitute tax advice. Always consult with qualified tax professionals for your specific situation. Tax laws are complex and change frequently, especially for cryptocurrency.